Investment products are not FDIC insured or bank guaranteed and may lose value. Hello everyone, I'm Sean Snyder, Head of Investment Strategy at Citi Personal Wealth Management. Thank you for joining our 2017 Mid-Year Outlook. Today we're going to talk about the top 5 questions on investors' minds right now, ranging from the stock market to North Korea. Everyone has heard of the Trump rally, but there's a lot more going on than just the events in Washington. In fact, the most recent rally really started in February of 2016, with global stocks climbing higher in 11 of the past 12 months. So why have global stocks been rallying? One reason is that global growth has been on the upswing since about June of last year. This chart is showing a measure of global growth called the Global Purchasing Managers Index, or PMI, versus the MSCI All Country World Index, which is a measure for global equities. For those unfamiliar, a reading above 50 on the PMI is thought to mean that the global economy is expanding, while below 50 is generally thought to mean that the economy is contracting. As we can see on the left-hand side of our chart, we suffered a global recession scare at the beginning of 2016, but have been recovering since. On the right-hand side of the chart, we can see that global stocks have been rebounding along with growth. Global corporate profits have also been rising, particularly outside of the United States. We see this as one of the primary reasons that international stocks have been outperforming U.S. stocks thus far in 2017. Emerging market earnings are expected to climb the most, with an expected rise of about 23% this year. Europe, excluding the UK, is expected to come in around 20% higher, and U.S. earnings are expected to be around 11% higher in 2017. There's a strong correlation between the movement in stock prices and earnings, so we think it makes sense that stocks have reacted positively to this upswing in earnings. So where do U.S. stocks go from here? Citi's official target for mid-year 2018 for the S&P 500 is 2,560, which represents a modest upside from here. We do think it's possible that we could see some choppiness in markets in the second half of this year, given that we've moved pretty far, pretty fast. But as long as economic fundamentals and earnings remain healthy, we think that a potential market pullback would probably be relatively short-lived. We tend to think of investing in stocks as a lot like flying on a plane. As long as the engines of the plane are still running, you might experience some turbulence, but you're probably not going to crash. In the case of stocks, the engine is the U.S. economy, which we think is doing okay. This chart compares leading economic indicators against the S&P 500, with the gray bars representing periods of U.S. recession. What you can see here is that outside of periods of recession, U.S. stocks tend to post positive returns on a year-over-year basis. On the very right side of the chart, we can see that leading economic indicators are actually rising. This leads us to believe that the U.S. economy will probably continue to grow at a rate of about 2% over the next year or so. We think this means that U.S. stocks will probably see further upside over the next 12 months, but valuations are looking a bit stretched, so we think a neutral position is warranted. So if we're neutral on U.S. stocks, what asset classes do we like? We continue to think that international markets like Europe and emerging markets will outperform over the next 12 to 18 months. We think that positive political developments and improving economic sentiment in Europe make the region attractive. In addition, Europe's lagged recovery relative to the U.S. may mean that the region will experience a bit of a catch-up phase over the next couple of years or so. We also think that emerging markets look attractive over the longer term. Aside from the earnings growth that we've already mentioned, fading fears of a global trade war, a weaker U.S. dollar, and more attractive valuations make emerging market stocks look appealing. As far as other opportunities, we continue to like investments that are not linked to the success or failure of the current U.S. administration. Those areas include things like technology, particularly robotics, which have recorded gains this year that are nearly double that of global equities. We also like global infrastructure stocks. While most people have been focused on the U.S., many international markets have underinvested in infrastructure, and we think that's starting to change. On the fixed income side, we still like emerging market sovereign debt, particularly Latin America, U.S. municipals, U.S. high yield, and U.S. corporate investment grade. So what are some of the risks to our view? People like to think of Wall Street strategists as having a crystal ball, but it's really more like trying to predict a football game. You often have a good idea what the outcome will be, but sometimes the star quarterback gets injured in the first quarter. Continued saber rattling by North Korea, central bank tightening, or failure to enact Washington's economic agenda all pose unique risks. A policy mistake by either the European Central Bank or the Fed, or failure to enact corporate tax reform could lead to strong market reactions. So far, U.S. stocks have largely looked past these risks, but these risks are still lingering. To summarize, we think that global equities have further room to run, but investors should expect more modest gains and be prepared for more market volatility moving forward. As always, we remind investors that periods of relative calm are a much better time to review your portfolio than when they are under stress. If you have any questions that we did not address today or are seeking other guidance about your financial future, please contact a Citi Personal Wealth Management financial advisor today. Once again, I'm Sean Snyder, and thank you for watching our 2017 Mid-Year Outlook.